How the Pension Protection Act helps individuals get long-term care benefits income tax-free. Presented by Jennifer Lang Financial Services. In retirement, your assets generate your income. Reallocating an existing asset you won't need to use for income can help protect you against an unexpected long-term care event. At Jennifer Lang Financial Services, we can help you convert your taxable assets to a tax-free annuity when the funds are used for qualifying long-term care. The process uses a single premium deferred annuity to help protect your retirement income stream if the need for care arises. Your one-time premium can provide a tax-efficient way to help pay for long-term care. And the issuing life insurance company may credit a higher interest rate to amounts withdrawn for qualifying long-term care expenses. By choosing to pay with a single premium, you are guaranteed that no more payments will ever be required. Also, there's no unexpected premium increases sometimes seen with traditional long-term care insurance. A tax-advantaged annuity used specifically for long-term care can help protect your retirement income stream. Did you know that nearly 3 in 4 non-qualified annuity owners intend to use their annuity to cover the potential expense of a critical illness or nursing home care? How does a long-term care annuity work? Reallocating existing assets like cash, savings, certificates of deposit, or other annuities into a long-term care annuity can help maximize those assets if they're needed to pay for qualifying long-term care expenses. And any funds that don't get used for long-term care will pass on to your heirs. Annuity-based products feature 2 accounts: the accumulated cash value and the long-term care accumulated cash value. Your money is credited interest each month in both accounts, with a higher rate applied to your long-term care accumulated cash value, allowing higher growth to provide more assets to help pay qualifying long-term care costs. Withdrawals are allowed from the long-term care accumulated cash value to help cover qualifying long-term care expenses, subject to the monthly long-term care limit and a 7-day waiting period. Let's look at an example. Ellen, a 78-year-old non-smoker, in good health, buys a long-term care annuity with a single premium of $125,000. Ellen is guaranteed $3,000 per month to help pay for qualifying long-term care expenses she may incur. And, by selecting the lifetime continuation of benefits option, Ellen can receive $3,000 per month for her entire lifetime. So, her initial premium is $125,000. The total initial long-term care benefit balance is $3,000 per month. Her lifetime continuation benefit will be $3,000 per month. Thanks to the Pension Protection Act, annuity-based products funded with after-tax money, non-qualified funds, receive distinct tax advantages. Qualifying long-term care expenses are distributed tax-free, whether from your base contract or the extended protection option. You can exchange an existing non-qualified annuity for one that is eligible for the Pension Protection Act advantages by either full or partial 1035 exchange. Be sure to discuss any taxability implications with your trusted financial professional. Your steps to get the care to meet your needs. Underwriting for long-term care annuities is slightly more flexible when compared to traditional long-term care insurance. It consists of several health questions on the application and a brief telephone interview. No medical exams are necessary. Benefit triggers. Benefit payments are triggered in one of 2 ways: if you cannot perform at least 2 of 6 activities of daily living, which include bathing, maintaining continence, dressing yourself, eating or feeding yourself, toileting, including getting on and off a toilet, and transferring, like from a bed to a chair. Or if you require care as a result of a severe cognitive impairment, such as Alzheimer's disease. Long-term care withdrawals. Actual long-term care expenses will be paid from the long-term care accumulated cash value, up to the stated monthly long-term care benefit limit. The annuity owner will receive the lesser of the monthly long-term care limit, or the actual charge for care. Additional benefits. Bed reservations can hold your spot in a facility if you require more specialized care in a hospital for a period of time. Respite Care allows a primary caregiver to take a short break to travel, or just have a few days off from providing care. To be eligible for benefits, the annuitant or eligible person, that is the covered person, must be a chronically ill individual with qualified long-term care services provided pursuant to a plan of care prescribed by a licensed healthcare practitioner. Cover your spouse. If you own an individual annuity, adding your spouse as an owner can involve a lot of paperwork. But there's a way to ensure your spouse can also enjoy the protection of your long-term care annuity. Transfer your existing non-qualified annuity with a single annuitant owner via 1035 exchange into a long-term care annuity, and designate your spouse as an eligible person. This makes your spouse eligible to receive payments for qualifying long-term care expenses. This is a simple way of securing access to long-term care protection for your spouse who might not be listed as an owner or annuitant on your current annuity. Experience guaranteed cash value growth. Access up to 10% of your funds with no surrender charges for non-long-term care withdrawals. Partial surrenders will reduce the amount available for long-term care expenses. Let's recap. In 2010, the Pension Protection Act became law. Yet for years, one of the most important and powerful provisions of the Act has been entirely overlooked by many. The Pension Protection Act allows an individual to convert an asset, like an annuity, to tax-free income to pay for extended health care. If tax-free income isn't enough, the underlying asset that creates the income can triple in value. For example, a $100,000 asset can increase to as much as $300,000 to pay for extended health care, thereby growing the tax-free income from the asset by up to 3 times when used for extended health care. The income from the asset would be more than $4,000 per month for up to 60 months. This provision can work with any cash asset like a savings account, but it works exceptionally well with in-force annuities, and here's why. Interest in an annuity grows tax-deferred. Indeed, that's one of the excellent features of the annuity. But when you begin to take money from the annuity, the interest acts as ordinary income, causing your total income to increase, potentially putting you in a higher tax bracket. This scenario is often referred to as a tax time bomb. The Pension Protection Act allows you to take the income from your assets tax-free. So why did Congress add this provision to the Act? Well, Congress realized that in America, we have an extended healthcare crisis. They knew that more than 10,000 people today are turning age 65, and 70% of those people would need some level of extended care. Most are shocked to learn that the average cost of extended health care is $3,500 per month for assisted living, more than $9,000 per month for nursing home care. Here's a question to ponder. What are the consequences to others if you need extended care? When a spouse or loved one becomes a caregiver, their entire life changes. Spouses lose their freedom and quality of life. If an adult child is involved in providing the needed care, their lives are affected too. Many must quit their job to care for an elderly parent. And don't think that such actions will bring your family together. They can tear families apart. To avoid such a scenario, Congress added this vital provision to the Pension Protection Act. Americans are living longer than ever, with average life expectancy nearing 80 years in 2015. At Jennifer Lang Financial Services, we provide options to help extend and maximize your protection for as long as you need it. Long-term care needs are unpredictable, so we shop for the right long-term care annuity, with continuation of benefit options to ensure you and your family remain covered after your initial long-term care benefits are exhausted. Some diagnoses can require many years of care. Not all products offer protection for the extent of a lifelong condition like Alzheimer's or dementia, instead of for just a few years. The continuation of benefits protection option can be paid for with either a single premium or continuous premiums for your lifetime. Premiums are guaranteed to never increase, even on a joint policy if the first client dies. Availability of annuities may vary by state. Let us prove our commitment to helping you craft a sound financial strategy. Experience for yourself what it means to be our customer. To learn more about how you can triple an asset and create a tax-free income to pay for extended care, go to www.annuityquoteadvisor.com or call 651-314-4812 for a free annuity quote. Thank you for attending. Stay safe.